Hello everybody, welcome to Macro Atlas. Today we're going to be discussing the three theories that Bitcoin could have playing out in the next few months. First of all, I'm Mo. I'm a crypto and macro market speculator. I've been a speculator for the past 7 years and was able to turn a small humble portfolio into 6 figures this cycle. So I hope what I'm going to share now is basically just my trading notes on Bitcoin. So I hope some of that can teach you some things, and if you do learn some things or get some ideas, do please leave a like, and if you enjoyed this content, do subscribe so you don't miss another video, right? So the first theory we're gonna discuss today is recency bias, right? So recency bias plays out a lot in markets, especially for Bitcoin, because it is a young asset, and if you can take snippets, price snippets from previous uh, price action, and then it does usually reflect it in some ways on recent price action. The most recent it is, the more is going to play out. And of course, if it's a macro view, then it's a macro recency. If it's a local, then it's a local. So I'll give you just one example of how this can be used. One of the things why I knew this could be the top here is because, well, I used we were gonna delete this is the volume candles. I do highly suggest it, but for this one, we're just gonna use normal candles. Yeah, one of the reasons why many people, including myself, understood that this could be the top right here is because recency bias. So if you take the previous bull market, right, and you look at the first top here and the second top, first top, second top, you can even see the similarities in this first leg right here, which we got here before the second top, and even this here. So this consolidation area period reflected in a way in here. And that consolidation period before the first top can be reflected right here. And if you take basically some of the candles here and put it here, then you get an elongated version such as that, because here it was shorter. So recency bias does work out in many ways, and I do highly suggest that some people take it more seriously and incorporate it in their trading. Today I'm going to show you how we can incorporate that in one theory. And of course, it shouldn't be like, oh yeah, this will happen because recency bias. No, it should be like, this is one variable, one factor that could affect the price action of the asset class to some degree of probability, right? So we're never sure about anything. We just assign probabilities to theories and trade according to the probabilities. That's at least how I trade, right? Because if you're too sure, you're going to increase your side too much, and then you're going to be caught off guard, and you're going to be just holding a bag of huge losses, and that's never okay. But if you think of it probabilistically, then you will like, yeah, if the price doesn't do that, or if the macro conditions do not meet those certain criterias, then I might reduce my exposure or cut my position completely, and it's fine. Let's make sure, just to make sure you have small losses, but um, when you write, you make sure you get the full like move, right? One way we did it here when we discussed shorting this period, yeah, we got stopped here and here, but we made sure our losses were limited. But when we got it right here, you can see that we exactly got the whole move. And if you check other videos, I'll show you where the price actually went. It went 2 hour. We discussed that this is based on history. This is the probability zone that we'll be hitting, but due to the matureness of the asset class, we will not drop below the 200-week SMA, and that was for that move, right? And actually worked out like that. We hit right this area, and of course we had why this zone is because of that. So it was the intersection of many theories. Theory one was this. I'm not going to discuss the theories in detail, but you can watch the previous video. The red box here, the yellow box was our highest conviction theory, which was here, and a blue box was another theory. And the price actually went to that intersection of those three theories, which was very, 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 very interesting. And it shows that probabilistic and macro thinking does actually get you somewhere. So we captured the whole move here, even though we got stopped a few times there. And this is what we're trying to do with the same price structure right here, right? So we discussed maybe this could be the top, but maybe we could go higher, and therefore we placed some shorts here, and we expanded it as we go down, but as the price action did not meet our criteria, we exited with a small loss. that's the basic idea of at least how I trade. And of course, you should find your own trading style, but everyone's trading style should be incorporated from other people that you take, and you sum it up, and you make your own trading style, something like that, right? So the first theory is recency bias of this move right here. So you first got some kind of consolidation zone at the start, which can reflect that area, even though this was making higher highs, you were making lower lows. But that's a caveat we can consider, no problem. After that, you get another sweep of the highs, another sweep of the highs here, and then another also rise to the top, right? And we got here another raise. If you take the price snippets of this zone and put it here, then you can see we might be in time to actually reach the end of the consolidation period and maybe form a breakdown of the structure. This why we've discussed maybe in the previous video, that I might be placing shorts here. And of course, if you're not shorting the market, don't worry. I'm going to get to the accumulation advice of the video, and where you can see, because even if you're not shorting the market, right, the market is going down. That means if you have higher probability that the market is going down, then you shouldn't really accumulate now, or accumulate in smaller portions. But if the market is going higher, then now is a good time to accumulate, right? So even if you're just accumulating for the long term or just the next cycle, then it is important to capture near the bottoms rather than catch a falling knife. My first trade ever was Alibaba, and I remember I've lost a lot of money on that trade. It was going down, and I kept buying it. It went down more, and I bought more, and it down more, and I bought more. At some point, I was like, "Oh my God, I'm losing a lot," and I started to understand the macro conditions of it, and I started to understand that China's stock market is not going higher anymore. So I lost 50% of my investment, and I got out. Right? Be careful of falling knives. So I think you can learn. I learned. I During that time, I was actually listening to Peter Thiel, and his advice was like, don't invest in, like, don't invest in falling stocks. Be careful, be wary of falling knives, because if you catch the falling knife, well, you're gonna get cut. Yes, that's my point. Where I like to accumulate is not really at the bottom, because finding the bottom is difficult unless you have a high conviction strategy, right? If you're accumulating, then imagine this is the price structure. We go down, price structure, and then you don't really accumulate here because you might go down again, right? Where it's good to accumulate is if, for example, in Bitcoin, it's more easy after 1 year of the peak, you get the trough, right? And maybe that works for Bitcoin, but I would accumulate in small percentages. But now is not the time of the cycle to accumulate. That's number one. Two, it's better to accumulate when we start to show some strength and a little bit of higher highs, right? So I would maybe get some positions here, but not too much, to be honest. I would have like stop losses inside and everything. But when you actually form the first higher convincing high, then I'll start actually accumulating. I'll put like 20% of my investment here, and then you actually start rising up or like consolidating here, and this will be the best time to accumulate. Now you would get, for example, say we are here, where I think we are right now. I think there's one more leg down move. Then you would have to, one, lock up capital for who knows how the long what's the period of time that you're gonna have to lock up. So there's an opportunity cost, right, to your capital. It can be used somewhere else. That's one. Two, you're gonna feel the pain and stress, and maybe sell your investment right here at a loss, which a lot of people do. But if you wait till you see a market structure that is changing, they can see in the camera. Excuse me. It's okay. So if you actually wait for the change of market structure, the market structure is adapting, the market structure is showing some bullish signs, then you would get the same price that you would have gotten here, but at a much better price. That's one. No, sorry, same price, but at a much better time, right? Investment is all about not only the price you get, but the timing of when you get it. One, again, you wouldn't have locked up a lot of capital. Two, you wouldn't have caught a falling knife. Three, you got the same price. So my advice to the bulls is, well, number one, not to the people who want to accumulate, is wait for them, maybe time the cycle to accumulate. That's one. Now is not usually the time. It's usually 1 year from the top, 364 days to the bottom. We've shown that in a lot of videos, but I'll show you again soon. Yeah, I'll show you, sure. We can just show one example, one quick example. So if you go to the, we don't need the weekly now here. Okay, let's do that. Measure top to peak, and interestingly is 365 days. That's theory one, okay? And the second idea is I actually like more to invest. Well, when I invested in this bull market phase, I had some investment here, but it was very minor, very, very minor. I accumulated more here because it was 1 year. And then when I saw the change of market structure right there, I doubled down. And that was a good choice. That reflecting on my investment for the previous bull market cycle, that was a good choice for me. And that's what I'm saying. So maybe wait until maybe you see some market change of market structure if you think this is the bottom, which is highly unlikely. But maybe if we go down here, we do that, and then we go up, and then that's the best time to accumulate. With that said, yeah, theory one is recency bias. We could be on the verge of breakdown of this market structure. So if you say that's the low here, let's make some. If that's the low here, the range low, that's the range high. The range high is way higher now. That's the range high. Then we might be breaking this structure very, very soon, right? And we might be heading lower. So my target, I'll show it soon, but I think we're heading in this range right here, right? The second support area. And there are theories that actually support that idea. We will discuss them later a little bit. So that's theory one. Theory two, which got invalidated, is the theory that we might be in this zone. And now it might not be fully invalidated, right? Because we see this market structure right here, very similar to here, and the whole recency bias is working out. We should be here, correct? But usually that takes, if you go and analyze all previous market cycles of that specific zone or market structure of all Bitcoin previous market cycles, then you do see a similar structure playing out. And it should be maximum 28 days, and it could go as high as 39%. But now we're beyond it. We doubled from that range. So maybe we are deviating by a lot, and that theory may hold. But for now, I'm placing a lower probability that we are going soon down. And if you what you notice here is we got 1, 2 week. You see there's a long week first, which we did got here, and then 1, 2, 3 weeks here of redness. Here it was 2 weeks, but then you got a similar white candle with a long wick to the upside, and that's when I was like really doubling down on that theory, and it was actually around that time zone, but it just got invalidated with that green candle right here. That was pretty bullish. But are we going to get invalidated with a bearish candle again and maybe stick to that theory and extend the time horizon? That's possible. But that candle just places a much lower probability on that theory. Third theory that we're going to be discussing is the one you're not going to like the most, but it's important that we know, that we understand that this could play out, and this is one possible scenario for, okay, we're going to use a different chart for this bear market structure and cycle. And that theory says that we are basically here, and that is a large consolidation zone. Okay, it can range a lot. If we see, it can go range 106 days, sometimes 281 days or 116 days based on this analysis. And I'll point out where this zone is in all previous market cycles, so you can get a better idea of why this could be a high chance of occurring, right? We've discussed this previously and it helped us a lot. I think a lot of people agreed with this view on the markets, and we're going to discuss it slowly. So what do you get after bear markets is basically the first leg move down. That sets the tone and the support line, sorry, for the consolidation phase to come. And then after that, you do get another second leg down move, which forms the bottom of the bear market cycle. That theory says we are here and we still have one leg down to the downside, and by understanding the first leg down move, we can actually outline the support and resistance line for that consolidation zone. So after the first leg down move, the bottom of that leg forms the support line of the consolidation phase, and you do actually form the resistance line right here on the first wick, right? That's the theory. And that period actually, for example, in this area, before breaking it down to the downside, ranged around 281 days. Okay. I would like to take the weekly, actually, and I'm gonna delete those, and like that, we can have a better understanding of what's happening. Similarly, if we go, for example, forward one cycle, that's the first leg down move, see? And that forms the support line, but the first wick down here forms kind of the resistance area. So this area here, this first consolidation area forms the resistance area. Okay. Similar here, that consolidation here kind of formed the bottom of that consolidation period right here, formed the resistance area of one resistance area, and here you got more and more. You can see how this move is considerable for that consolidation area. Similarly, here you get a first leg down move, forms the support, and the first consolidation area, or the first like rally of the bear market, kind of forms to some degree the support line. Okay, like here. Of course, we can wick above it and etc. But that's the idea. Breaking of that consolidation zone forms the second leg down move, which comes to the bottom of the bear market. Similarly here, bottom, similarly here, near the bottom, but we got another wick down, which wasn't so far from the bottom. That's the theory, and it helped us a lot actually understand where is this zone and fit it with the idea. So if we look at the current market structure, we see that's the kind of the half of the move. We formed the consolidation period, which forms the resistance line of that coming consolidation period. The first leg down here to fully forms the bottom, and if you look at the previous cycle, that also corresponded to that area. So this is where the red zone comes, right? And the red zone plays out in the theory as well a lot, which is the consolidation period before the peak of the market cycle. Here, if you zoom into the daily, you will see it. It wasn't as major, but we will still calculate it in one way or another. I'll show it to you, for example, here. Yeah, right there. Okay, so that's my third theory, and I hope those three theories gave you an understanding of how complex the market structure is, but I would assign probabilities as follows. Okay, the first theory we talked about that thank you, that we might be going down, I would assign to it around a 40% chance. Okay, The second one, I would assign to it that that one I wouldn't assign anything to it, to be honest, because it's a very small chance for me that this is working out. The consolidation higher is around 40%. Okay. Seriously. You can see as we catch the tops and we try and increase our position size, and if we see a change of market structure to the upside, we actually start selling, and we might actually still come up with a little bit profit instead of losses. Yeah, that's another support in the first theory. Where's the probabilities that we assign? Yeah, no, I have a lot of ideas. Okay, let's use just this chart. Okay, so the first one is 40%. 40%. Second one is also 40%, which is that the first one is that we're going down soon, very quickly, very soon. The second one is that we're getting a consolidation expansion area that can range to 150 to even 300 days, 280 days, but I doubt we're going to get 280 days. I think this consolidation period is going to be much smaller than 280 days. Recency bias says 160 days. And the third one is 20%, which is we are going up. Okay, it means we are going higher. It means maybe there's no market extended cycle. I'd even put at 15%. I highly doubt this is possible, but it is a scenario that could be, of course, possible. Unless, if it was not possible, I would just go all in on shorting and not worry about the upside. But that 20% always gives me like, be careful. You don't want to lose more than you can. So you should always think that you could be wrong. Maybe it's not a bear market. Maybe the bulls are right. Maybe it's an extended bull market in a war and deteriorating macro conditions and higher unemployment and higher inflation and whatever. Actually, one thing you have to discuss is we could be actually in a stagflation period transitioning to a stagflation period. Hear me out. Oil prices going up. That drives inflation prices. Inflation keeps rates higher. All right, so now you get rates higher. That keeps bonds attractive, right? Because that's why gold is going down, by the way, because oil going up and inflation going up. So the Fed definitely cannot, well, not definitely, but less likely and much less likely to cut rates, which means the bonds and yields do have higher rates, right? And if they do have high rates, then people are like, why should I hold gold? I can put them in government bonds that can give me an interest, because gold is not really giving me any interest, and we kind of reached a peak. Also, why gold is going down could be because a lot of countries are selling their stocks for cash to buy equipments and guns and pay salaries for their soldiers. So be careful of gold, please, and understand that right now. So if you have this inflationary period and inability to cut interest rates by the Fed, and you have a deteriorating, okay, that causes inflation, right? That causes inflation. And if you have deteriorating macro conditions with higher employment, and PPI came up very difficult, and GDP, you're not getting really any predictions of or forecast of higher growth for the economies, especially times of war. Okay, in times of war you do get sometimes a little peak if you can print money, but we cannot, so maybe that theory is cancelled out. Slower growth, recession fears, higher employment. With inflation, you don't get a recession, you get something worse. You get stagflation, which is recession and high inflation. So you have a recession and an inability of the Fed to actually print money and lower interest rate and boost the economy. So you get a period of high inflation and recessionary environment that is elongated because the government and the Fed cannot intervene to reverse the outcome of the situation. Therefore, I do not think we are going up, and I place 10% for it. And we are going 45 here, 45 here. This one goes for consolidation, and this one goes for breakdown. I hope you enjoyed this video. Maybe if you learned some things, do please like and subscribe. And we did some rebranding to the channel from Cryptonomy to Macro Atlas. Let me know if you like the new colors and the new naming. And I'll see you in the next video. Peace out. Thank you.